Good afternoon, everyone. This is Rob Barnett from Bloomberg Intelligence, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. So today, Brent oil is over $120 a barrel, and I would highlight that Salih, you and Will just put out a note taking a look at the oil market fundamentals. You noted in a scenario that you call crunch that oil could potentially flirt with $200 a barrel. So given this very provocative idea, I want to come to you first, frame what's going on in the oil market, how tight is the supply-demand balance, and what could tip prices in that direction?
Thanks, Rob. Hi, everyone. Hope everybody's doing well. So we've updated our scenarios for Brent oil prices in our note yesterday. And I should say that our base case scenario used to be $120 a barrel for Brent, which is now $130 a barrel, because we see continued tightness in the market, and mainly because of the European Union oil ban at Russia. Just tightening what's already a tight market. We see about 2 million barrels of per day of disruption to Russian flows. As you mentioned, this is already, when we look at the physical market, it is on fire. We have demand, which has been very resilient, and we should remember that we had about 2 million barrels a day impact from the Chinese lockdowns, which seem to be easing now. So that will add to oil demand as we look to the next couple of months. So that's the base case scenario. But when we look at the crunch scenario, so this, I think we just have a very long tail here, because when we look at a scenario like the crunch one that we have, where we see a bigger disruption to Russian oil flows, we see Chinese oil demand perhaps coming back stronger than many think. Then we would be in a scenario where we just don't really know how high oil prices can go, because in the physical market we just perhaps wouldn't have enough oil to match this rising demand. So on the supply side, this is something that we've been discussing for a while now. We usually depend on OPEC to fill in the gaps, but what we've been seeing for many months now is the group is really struggling to keep up with the rising output targets, and we see them continuing to struggle. And when we look at the group, we've been highlighting that probably only Saudi Arabia and the UAE are the ones that will be able to increase output meaningfully in the next few months. But then we need to remember that, sure, they can do that to keep the market relatively balanced in the next few months. But then what happens when we completely exhaust spare capacity within the group? We then run the risk of the rally turning into a panic-driven rally, because historically low spare capacity levels are a very bullish indicator, because when you look at the oil market, unexpected supply disruptions is something that tends to happen, and we would then be in a situation where we have no room for any unexpected supply disruption. So our base case scenario remains around $130 a barrel, but our crunch scenario is where we see supply demand being dislocated even more, in which case we could get to these levels where we kind of force demand destruction to force demand back to levels to match demand to rebalance the market. And $200 a barrel, when we look at the peak nominal value of oil price back in 2008 was around was just about $140 a barrel. And when we adjust that for inflation, that would be around $200 a barrel in today's dollars. But again, it is a different situation now to 2008. When we look at the demand side of the equation, you're just coming out of a pandemic. I think a lot of people who have been home for a couple of years are really eager to go out, drive more, take holidays. At the same time, we do have subsidies and oil tax cuts in some parts of the world, which are also supporting the demand side of the equation. So all of this combined, we see risk still very much skewed to the upside for the oil market.
Okay, Will Hares, I want to bring you on to respond to this a little bit. We're in a very elevated environment for oil prices. What are the oil majors doing in terms of Capex? Are they investing more in new supply right now? And what do you make of the idea? Did they underinvest in the run-up to where we are today?
Yeah, thanks, Rob. So very quickly on the second question, yes, I think it's very clear now that the entire upstream, global upstream sector was structurally underinvested, probably for several years, going back to 2014, 2015, after the oil crash then. And I think this is still going to persist. We're looking at still incredibly disciplined capital spending from these companies, maximizing free cash flow, and most of that free cash flow is being deployed into distribution programs, namely buyback programs, seeing enormous buybacks being rolled out from nearly all the majors, and this is because this lever represents an easier, more flexible way to distribute capital than locking themselves into these large dividend programs, which were cut pretty significantly for most of these companies in response to COVID. But on the upstream side, we are not seeing a meaningful increase in allocation of capital towards oil projects. We continue to expect this energy crisis to conversely accelerate these companies' energy transition strategies, and this is because their strategies are built out over several years. There's long lead time projects here. The Europeans in particular have very limited exposure to U.S. shale and short cycle levers to respond quickly to optimize exposure to these prices, and so you won't see a big change in upstream oil capex, because the fruits of that labor will show up several years down the line, when the companies would miss out on the prevailing oil price scenario. So instead, we think, and I think it's been borne out through some of the headlines that we've seen, an acceleration in energy transition strategies with continued M&A, largely focused in renewable power, but also in EV charging networks, a little bit in batteries, continued development in nascent development in hydrogen as well.
Thank you, Will. One of the ideas that we've been discussing as a group is, what makes this time different? And Salih, you already mentioned the run-up in oil prices that we saw in 2008, and we've been looking back and kind of deconstructing, what was IEA thinking at the time? What was OPEC thinking at the time? And how do you compare kind of their thinking to back in the sort of 2008 price spike to where we are today? And I guess what's the potential that we see demand response at the current price that we're seeing? Because you did mention demand being pretty resilient. Are we going to start running into some demand destruction where we are, or do we have to go higher?
I think this is a very interesting question, and we were looking at some of the IEA and OPEC reports from back in 2008, June, July period, and when we had the run up to these peak oil prices in nominal terms. And I mean, it is awfully similar when you look at the buildup in the Bloomberg Commodity Index this year and compare it to the buildup in 2008. I mean, it is awfully similar. But I think the main big difference is that was mainly demand-driven, mainly China-driven, whereas I think this is more of a supply story this time. And I mean, looking at these reports, I think one big difference now I could tell is a lot of these reports, when they were talking about non-OPEC growth, which at the time included Russia, they were talking about some of these projects that had marginal growth from Russia. I think this time around, that is probably out of the question. I don't think, I mean, we're talking about the short-term disruption to Russian flows, but I think there is the risk of long-term impact as well, as there is just less investment going to Russia. So that just, I think, exacerbates the supply problem that we have. I think another difference could be that these reports were talking about how refining margins were being impacted by the higher crude prices, and they were not doing so well. Whereas, I mean, when you look at the refining margins now, they are at unbelievably high levels because of, again, when we talk about Russia, we tend to talk about crude, but there is obviously a huge disruption to oil product flows as well, especially diesel, which is bringing this shortage of oil products, which means refining margins are really good. And when refining margins are really good, refiners, I mean, we saw Gulf mention earlier today, they're just running at maximum capacity to take advantage of these margin levels. And when they do that, I mean, refiners are the ones that demand crude. That really helps oil demand as well. In terms of demand destruction, and this is, again, we've been talking about it for a while now, and these reports were mentioning and saying that at these levels we're really starting to see demand responding. I mean, currently we have some anecdotes of how perhaps some planes are not running because they either can't find jet fuel, especially in Africa, or it's just too expensive. I don't think these are meaningful levels where demand is being destroyed kind of notably enough to ease the run-up in prices. So I think it seems to me that we probably need higher prices to get more meaningful demand destruction that kind of helps rebalance the market. And I think I should mention one big difference also, going back to Will's point, is Capex levels. I think back in 2008, there was probably less. I mean, the setup was a lot more different in the sense that higher oil prices, I think, were really encouraging oil companies globally to respond and spend more. Now, I think the situation is a lot more different, where we have a lot more capital discipline, as Will mentioned. When you look at U.S. shale players, they're very focused on investor and shareholder returns over spending and output growth. When we look at majors, that is very much the case as well, but also they are increasing the share of their capital spending into low carbon solutions as well. And I mean, you could argue that NOCs such as Saudi Aramco and ADNOC are increasing their spending, but is it really enough to fill that gap? And I think the answer is probably not. So those were the kind of main differences and similarities that I could think of looking at some of these historical IEA and OPEC reports for the 2008 period.
Okay, thank you, Salih. I want to bring on Patricio Alvarez now. Patricio, you've just heard kind of the lay of the land on the oil side of the equation. European gas in many ways looks pretty similar. Not quite the same set of drivers, but we have seen European gas prices retreat since the initial Russian invasion of Ukraine, but they're still quite elevated compared with historical levels. We've even seen the U.S. natural gas Henry Hub price come up quite a bit, but it's still quite low compared to where we are in Europe. Give us a breakdown of the supply demand fundamentals for the gas market in your view.
Sure. I think one good starting point would be to see the origin of both the U.S. gas price, like natural gas price, and the European natural gas prices. I think it sort of comes down to this dislocation between a demand recovery and the supply response. Because now we're seeing elevated gas prices in the U.S., and mainly that's because they had a long, harsh winter where they did not have enough storage by the end of the winter, and now they're seeing demand bounce back, and that's sort of further exacerbated by expectations of a hotter than expected summer, so that increases the cooling needs. Everyone has an air conditioner in the U.S. Plus, the other side of the story is Europe pulling on that LNG lever, pulling gas away from the United States. So we see this dislocation sort of affecting both hubs regionally. In Europe, conditions have somewhat improved. We've seen a steady increase in LNG imports, something that we didn't see happening from the beginning of the year. We thought that these levels of LNG imports were a bit hard to sustain, but we nevertheless have seen them be sustained throughout the year to date, mainly from the U.S. into Europe. And what's important to note is that this largely hinges on easing demand in China. The lockdowns in China have dented demand significantly, and thus they do remain a risk for Europe in terms of upside potential for prices. If demand in China rebounds towards the latter part of the year, we will see again intense competition for those LNG cargoes. And that's sort of the lay of the land in terms of European gas. We've seen a strong recovery in storage levels. We're within grasp of the 5-year historical averages. So all in all, in better position than we were before. But it's also important to highlight that all these scenarios seem to exclude a potential curtailment of gas flows from Russia, which have been suppressed, but albeit nominally, I'd say. We haven't seen this strong, significant curtailment that we saw at the fourth quarter of last year. And any significant curtailment beyond what we are seeing now would definitely send natural gas prices into disarray again.
Okay, thank you, Patricio. I think the elephant in the room is all going to come down to geopolitics and Russia on both the oil and gas side of the equation, perhaps. Will, I want to come back to you to get a little bit more color on how Russia plays into the oil side. European Union, since we last came together, has come out with import ban for Russian crude. Give us your read on that and how you think it will play into the market as you look into 2H.
Yeah, thanks, Rob. So the EU has put forth an oil embargo on all seaborne imports of Russian oil into the Union. Immediately, this will impact about 2/3 of total, and that'll increase by year end to about 90% of total Russian imports into the bloc. There are a few exemptions for Slovakia, Czech Republic, and Hungary, who receive significant piped exports and are overwhelmingly reliant on Russian oil, and so they have been spared, the incremental costs that their economy would suffer from this embargo. But more broadly, we think that this will impact by a couple million barrels a day, keeping in mind that the actual estimates for the impact to Russian exports has actually come in below where most were expecting. This is as India and China have stepped in to fill the gap on the buyer side. But just more broadly, it fits in with what Salih was mentioning earlier, how it's just another post in the ground pointing to a tightening market in the future. And I think another element here that is underappreciated by most is that not just the oil embargo, but the broader sanctions from the Western allies on equipment and financial and economic sanctions, that this is going to result in a financial and capital starvation in the Russian oil sector. They were the second largest oil producer in the world, and while their production has remained relatively resilient, this will not be the case in the years ahead. We do not see any scenario in which these sanctions are lifted in the near term, even with a full pullback of Russian troops, which doesn't appear likely anyway. And this impact will be felt further down the road. We're already seeing it from equipment. Schlumberger saying that they aren't providing equipment to some of the big LNG projects out there, and the Russian companies cannot, effectively source high quality substitutes for some of the Western supplies and equipment for their oil fields that they were. So I think this is another angle that is important and will feature increasingly in the years ahead.
Will, since we last came together, the UK has taken some interesting steps on that potentially affect the supply side of the equation with a new windfall tax on the oil and gas industry. Is that a marginal impact? How much do you see things like that coming in to affect that tight supply-demand balance you mentioned?
So the UK is a pretty marginal producer at this point. It produces about 1.4 million barrels of oil equivalent per day, and that's about roughly half gas, half oil. So they're a small producer, less than 1% of the global oil market. But I think domestically it has an important factor here. The policy is really a blunt instrument. It's designed to alleviate the cost of living crisis, which I'm sure everyone is well aware of. But I think, ironically, it was in response to the public anger for BP and Shell. But instead, it's a 25% tax on North Sea profits. This will land disproportionately on the much smaller independent E&Ps that most average people have never even heard of. So Harbour Energy, EnQuest, Serica, Hurricane, privates like Neo, Ithaca, and Spirit. Most people have never heard of these companies, but these will be the ones who will be bearing the burden of this policy. And also, I think it's worth mentioning that these companies overwhelmingly have strategies that are focused on developing the mature reservoirs and late life assets, of which the North Sea has a lot. And also which the majors can't typically be bothered with because it's immaterial to their strategies. And so these smaller companies are actually disproportionately contributing more to the future energy security of the UK, which is being undermined by this policy. It all comes back to stability of a financial and tax regime, and I think this goes to show that the levels of investment in the future can and probably will be undermined by this. We've already seen some comments from BP saying that they may revise their budgeting, their long-term budgeting outlook for the UK, because when companies can't be certain that tax rates won't change in the future, that makes that's a pretty clear signal that that the attractiveness of that regime is declining, and also just underscoring that this policy sort of counterintuitively will risk energy security in the UK as a result.
Salih, I want to come back to you to kind of help get some framing on this as well, maybe from the U.S. side. In the solar business, President Biden has used the Defense Production Act to try to help incentivize new solar manufacturing in the U.S. This was just announced the other day. There are some folks in the oil community saying, hey, why don't you do the same thing for oil and gas in the U.S.? What's your sense on, A, whether anything like that's possible, and B, what kind of response do you expect from the U.S. shale producers as we look into 2H and to 2023?
So, I mean, as things stand, I don't think that would happen. I think very much the sentiment has been all this should be encouraging us to be moving faster towards renewables and away from fossil fuels. So, from what we hear so far, I don't think there will be any further encouragement for the U.S. shale players to increase spending. And I mean, at the same time, we really are seeing a lot of hesitancy. I mean, WTI price is about $120 a barrel. I mean, this is way above any break-even cost that any of these producers have. But I mean, you could argue that these companies work on the back end of the curve. So as long as the back end of the curve is still very low, perhaps they're not incentivized enough to be investing more. So I think, as I mentioned earlier, that's why I think we're still getting a very slow and very cautious response in capex levels, especially in U.S. shale, which arguably, I mean, when you look at the market, U.S. shale is the one, I mean, U.S. production is the one that used to be at around 13 million barrels per day and currently is just below 12 million barrels per day. So that could be that swing producer that bring those extra barrels to help with that supply crunch that we are working towards. But it seems that, I mean, these companies for a very long time, I mean, they had high reinvestment rates for almost a decade and very low returns. And now shareholders are telling them, I mean, don't do that again. Just focus on shareholder returns. Just give those returns back to us and kind of deprioritize output growth. So with all of that in mind, I think it will come back, I think, but it will come back too slowly. I mean, when we look at this year, we see the marginal supply growth in the U.S. At about 800,000 barrels a day, below 1 million barrels per day. It's probably going to be more next year. But when we think about this crunch in the market and this crunch scenario, we're very much focused on this year, and we are more worried about this year than next. So I think, investment is coming back, but arguably too slowly and too cautiously to help rebalance the market and ease this momentum in oil prices.
Okay, thank you, Salih. Patricio, on this same kind of front, there are many policy levers being discussed and moved around the world, not just in the UK, US, Europe. But you had an interesting note looking at UK windfall taxes at potential for them and how it could affect the utility side of the equation and perhaps some of the energy transition type of things that are unfolding in the UK. So tell us about your note and what you think of the potential for that.
Right. So in terms of the note and what we walk through is just, first of all, making an argument that a potential windfall tax levy on power generators in the UK would be a very blunt instrument, potentially even more blunt, if you can say that, versus a levy on oil and gas. That's mainly because of two reasons. One of them is that most of the power generation or the power in the UK is already sold forward. So that means that most of the companies here have already sold most of their power output for 2022 at prices that are significantly lower than the current spot prices, which are above 200 euros per megawatt at the moment. Just to give you an idea, the companies getting the highest average prices are at about 100 pounds per megawatt hour, which is still, it's still very much below that mark. So that sort of proves that they're not really benefiting from this windfall profits, as you want to call them. And the other factor that makes this increasingly difficult is the application of a levy, because you would have to sort of go into each company's finances and try to pick out which parts are already hedged, which are not. Some are subject to subsidies, some participate in capacity auctions. Just the system itself is a bit complicated to make this a one-off that's both materially impactful favorably for the government, and the other one is just very hard to actually move forward with it. And this has been the case that we've seen in Spain and Italy as well. They have moved ahead with windfall profit taxes on power generators, and perhaps the best example is Spain, where the regulator moved to amend the measure, which initially just said this is the price cap we're putting on power. Anyone making, or capturing any prices beyond that will be taxed on it. They could not move ahead with it because they realized that, most of the power volume was already hedged, was already sold forward, and they would risk actually bankrupting a lot of the big companies in that country. So the same would apply here. And the other point we wanted to make is that it would definitely be detrimental to the energy transition in the UK and in Europe as a whole. I think one of the arguments that was made to tax oil and gas companies was that these companies should reinvest their record profits back into the energy transition, and this just doesn't apply to utilities because they have been by and large driving investment in the energy transition, not only in the UK but in Europe as a whole. Just as a set number, we see our latest analysis of the Stock 600 index for utilities has consensus for utilities investing as a whole around 95 to 100 billion euros per year from this year up to 2025. So this just shows you the sheer amount of investments. And if you think from an economic perspective, perhaps trying to collect taxes today would come at a higher cost of capital to attract those investments needed to move ahead with the energy transition. In terms of, finally, just shortly on what I think I should have avoided this question, but perhaps what's the likelihood of happening, of this moving ahead and happening? I think given the lessons learned in other nations, in Italy, Spain, and now Portugal and Spain with the gas cap, price cap as well, given those lessons, I think there's low chance. The case to introduce a similar tax here is perhaps weaker than in these other cases, and we're probably going to see something more in alignment to what Germany has done, with Germany just placing on small rebates on actual utility bills and trying to let the companies actually pass on the costs progressively, let's say, to their customers.
Okay, thank you, Patricio. We'll have to leave it there. There were a number of questions that came in through the chat, so thank you for those. I don't think we had a chance to fully explore all of them. There was a question on polysilicon and the U.S. I would encourage you, if you haven't seen it, check out our primer on REC Silicon. The ticker for that is RECSINO. And then type BECO, and you can read our primer on the company. And they're a producer that has a facility in Moses Lake, Washington that may restart in the next couple of years that would be exposed to U.S. solar policy and what may be happening with polysilicon. Broadly, for any of the companies we've discussed, you can run a function called MODL these days. If you disagree with our view on maybe where oil prices are headed or where gas prices could go, you can plug in your own scenario for realized fossil fuel prices, see what it would mean for the company's income statement, cash flow, balance sheet. And lastly, I'll just highlight that Patricio and I have a webinar tomorrow where we're going to have some slides, some pretty pictures. We've partnered up with ING to discuss whether this elevated commodity price environment that we're going to be in is going to accelerate the energy transition or perhaps not. So please join us for that. You can find the details on SEMR, which is the seminar function on the terminal. But if you can't find it, shoot Patricio or I an email, and we will give you the details on how to join that. And last but not least, I hope everyone has a great week, and we hope to talk to you again soon. Take care.